Hi everyone, in this video we're going to be looking at capital budgeting or capital expenditure decisions. Now the learning objectives, by the end of this particular video you should be able to 1. Apply the concept of the time value of money to capital budgeting, 2. Use a discounted cash flow or other method to figure out the required rate of return for the project, 3. Analyze the impact of taxes on discounted cash flows and how they affect capital budgeting, and then 4. Apply the concept of relevance to discounted cash flow methods of capital budgeting. So first and foremost, here are the key concepts and things you need to know how to do. You need to understand how to determine the relevant cash flows of various types of proposed investments, and think back to some of the other things we've talked about in the course, namely how to figure out if a cash flow is relevant or not. Like, is it going to make a difference going forward? You should be able to compute what's called the CCA, or Capital Cost Allowance Tax Shield. Keep in mind that has changed in recent years. In the past, there was something called the half-year rule, and now we're using 1.5 times. So there are two different types of CCA rules that you have to be aware of, and then understand how to analyze different capital budgeting decisions. In terms of relevant cash flows, what we're talking about here are which cash flows that should be included in a capital budgeting decision, and ones that you should just exclude or ignore in a capital budgeting decision. The ones you want to include are the cash flows that are incremental to your analysis, or you could look at each project in isolation, and that's called the standalone method, where you look at the total cash flows in or out for a particular project, and then compare them side by side. You have to ask yourself, in determining whether or not a cash flow is relevant, will this cash flow occur or not occur if we accept the project? So just be careful of generalizations around whether a cost is fixed or variable, or whether all relevant costs are variable or fixed. And in any case, you have to just ask yourself, will this cash flow occur or not if we take on the project? If the answer is yes, then it should be included in your analysis because it is incremental to taking on the project. If the answer is no, then it should not be included in the analysis because it's going to happen anyway. If the answer is some of it or part of it, then you include the part that does occur as a result of the project, and you don't include the stuff that doesn't incur as a result of the project. Watch out for sunk costs. And I know we've talked about this many times, but I know the temptation is often to look at costs that we have already spent, but those need to be excluded from your analysis. So for example, if a firm has spent $1 million on research and development, before making a decision to proceed with a project, the $1 million should not be included as part of the cost of the project, right? It's sunk. Similarly, we can talk about opportunity costs, and these are the costs of foregone opportunities as a result of taking on a project. So for example, if you've already got a piece of land that you want to use for a particular project, even if you don't have to pay for that land again, you could be using the land for something else. So you have to consider the opportunity cost of using that piece of land to take on the project. Or said another way, you must charge the project for the cost of that land, even if you don't have to pay for it. We also have to consider what are called positive and negative side effects for taking on a project. So for example, if I sell you a printer, I might sell that printer to you at my cost, at a very good discount even, because I know that if you buy my printer, you're still going to have to buy my toner. I heard recently that Peloton, for example, sells their bikes at a very good price, even though it seems quite expensive. The bike itself is actually at a very reasonable price for what it is, and then they make their money on the monthly cost that you're going to have to pay them to continue to use the exercise bike. Watch out for negative side effects as well. One of those things is called cannibalism. Cannibalism is where if you put out a product in the market, or you put something out in the market, the existence of that particular product takes away from the sales that you would have had because people buy it instead of your other product. All right? So if Air Canada has the Tango airline as well as their main line, or their main airline, you might lose some particular travelers to Tango that would have otherwise bought a full fare ticket. You also need to consider what's called the net working capital, and the net working capital is where your cash is tied up in the project. So as a result of spending money on the project, you can't use that money elsewhere. Now we've seen examples of that in other chapters. So for example, with EOQ, we looked at the holding cost of inventory. You would have seen it in in carrying costs of inventory as well. I think we looked at it there. So just be aware that there is an investment in net working capital if you're tying up your money in one project that now can no longer be spent on something else. Capital budgeting, we're looking beyond the current year. So we're not just talking about something that's going to be a purchase that you make right now. We're looking at something beyond the current year. And because of the long-term nature of the investments, we have to consider all of the other long-term factors as well. Now, in the short run, you're still going to have decision criteria. You're still going to be comparing alternatives. You are still looking at qualitative and quantitative factors. You've still got a decision model that you're going to go through. But these are similar things that you're going to need to think about in the long term with capital budgeting decisions. If we're talking about the types of benefits you might run into, we might look at, for example, a project reducing the amount of inventory you have to keep on hand. And as a result of having less inventory on hand, you're having to spend less money on keeping that inventory on hand. Maybe this saves you some floor space that you can use for something else. Actually, on that point, if you're freeing up floor space but you can't use it for anything else, then that's not really saving you much, is it? You're just going to have extra floor space that maybe makes it easier to walk around. But if you can actually use that floor space to put other products there, or you can give back some of the floor space that maybe you're renting, in that case, that is a benefit you'd need to quantify. If you get improvements in quality as a result of buying a new machine, those improvements in quality, again, are something you'd want to think about and factor into your analysis. Maybe now, as a result of investing in this new machine, you have to do less rework. And remember that rework is a non-value added cost, right? So if we can improve the quality of whatever it is we're selling, we're mitigating or reducing the amount of rework we have to do, and as a result, we're bringing our costs down. In some of the CPA cases, you're often going to have to tie this to your customers or to external factors or external users. So think about the effect on your customers. Maybe they're happier because they're getting things quicker. You can turn a project around more quickly, or put a product on the market more quickly. Tie back to internal integration. Maybe it makes it easier to do things inside the company. It uses less overhead. Maybe things are faster to build. Maybe it makes you more flexible. By having a particular new machine, it allows you to produce a number of different products you previously couldn't produce. Continuous improvement or radical improvement. Maybe by investing in this new machine, you can improve more quickly. It allows you to bring better jumps in whatever it is you produce into the open market, right? So, you want to think about all of those types of benefits quantitatively, but also qualitatively when assessing a project. Okay, so the phases in capital budgeting. Step 1, you want to identify your potential investments. You select the investments that you're thinking about, and then you follow up by monitoring whether or not that investment was as successful as you expected it to be. In terms of long-term considerations, typically $1 today is worth more than $1 that will be received in the future, and I realize that interest rates are extraordinarily low right now, and I realize that in some parts of the world we have negative interest rates, but for now, let's just assume that it costs you money to borrow money, and that $1 tomorrow is worth less than $1 today. Okay. Also keep in mind that there are capital outlays that. Also keep in mind that a capital outlay is going to involve risk and uncertainty. If you invest in a particular project, that may or may not be successful, and if it's unsuccessful, you've spent money on something that isn't going to give you a return. And typically, the higher the risk that is associated with a project, the higher the return you demand from that project. Now, in the real world, companies are going to use multiple ways to look at whether or not a project makes sense. Discounted cash flows are the most common method, and that's where you look at the cash flows from now until the end of the project, and then you express them in today's dollars, and you look at whether or not the project is going to earn you the required rate of return or not. Now, these are used in more than 75% of firms, but the accounting rate of return also had a usage rate of around 20%. In fact, more than 50% of companies will even look at the payback period, just how long is it going to take you before you get your money back, as a method of deciding whether or not to undertake a project or not. Now keep in mind, in addition to the quantitative analysis that you do, you should also be looking at the qualitative factors as to whether or not the project makes sense. If you're using the internal rate of return method, what you're looking for is the rate at which the NPV is equal to 0. And what you're saying there is it's the discount rate at which the present value of the expected cash inflows from a project is equal to the present value of its expected cash outflows. A project is accepted if the internal rate of return is equal to or greater than the required rate of return. So what you're looking for is the rate at which the NPV is equal to 0. And you can do this either using Excel or on your calculator. It's not a learning outcome for this course, but just to keep in mind, if you want to look it up, there's plenty of videos on YouTube where you could find how to punch the numbers into your calculator to spit out the IRR. Now, there are also equivalent cash flow approaches where you ignore the time value of money. There's the urgency method, qualitative method, accounting rate of return, and payback, which I've already alluded to. Now, in the urgency method, you're using persuasion techniques or emergency persuasion techniques, saying, we need this now. This needs to be done for whatever reason. Maybe something major happens in the world where you now have to spend a bunch of money right up front. And here you're not really using any scientific principles. You're not really thinking through whether or not you need to spend this money. You're just going to spend it because it needs to be done. Maybe your window's leaking, and instead of spending the time and money looking for different vendors who might be able to fix your window, you just need to get it done. You call the first vendor you can find to get it fixed. Okay? In the qualitative method, what you're going to do is you're going to look at whether or not the project makes sense strictly from a qualitative perspective. So, for example, buying a gym membership or setting up a gym for all of your employees probably will not make sense quantitatively. Like, you know how much you're going to spend, but you don't know how much money that's going to bring in or how much that's going to save you in better health benefits for your employees. So here you'd probably just buy it because of the fact that it makes sense, it's going to make your employees happy. You're not going to do it because of the quantitative factors there. In the payback method, what you're looking for is how long is it going to take for me to get my money back. So typically shorter payback periods are preferable. And projects will be weighed according to how long it's going to take to get your money back. The reason a lot of companies like the payback period is it's easy to understand, but it doesn't consider the time value of money, and it doesn't consider any cash flows beyond the payback point. So if you've got uniform cash flows, this becomes a very easy calculation to make. You take your investment, you divide it by the uniform cash flows, and this will give you a period of time that it's going to take you before you get your money back. So it might be, invest $1 million today and you'll have your money back within 4 years. And then whether or not that's reasonable to you is a decision you can make at that point. If you have unequal cash flows, you have to look at the point at which you will recover your investment. So here, let's say we started with an investment of $150,000. And in year 1, you're going to save $50,000 as a result of investing in it. Or maybe you make $50,000. In year 2, you're going to save $60,000, in year 3, $80,000, in year 4, $90,000, and then in year 5, $100,000. So ignoring the time value of money, you'll notice that after year 1, we've saved $50,000. After year 2, we've saved $110,000. And then sometime between year 2 and year 3, we actually save more than the initial investment. And at what point does that happen? Right? And that becomes your payback period. So if we look, we've got year 1 and year 2, right? That's 2 years. And then in year 3, we have to recover yet another $40,000. Now in year 3, our cash savings are $80,000 in total. So that's going to give you 40 over 80 times a year. That's a half a year. So our total payback period is 2 years plus a half a year, which is 2.5 years. Just a small little detail here that does not mean 2 years and 5 months. That's 2 years and 6 months. Don't ask me how I know that. Right? It's a really common mistake for students to mistake. So just watch out for that. If you get 2.5 years, that's 2 years and 6 months, not 2 years and 5. Okay, the accounting rate of return, it's a measure of income, like your accounting income divided by your investment. So if your ARR is greater than the minimum target rate, then you'll make the investment. The reason people like this is because you're taking an accrual accounting measure that's right off the income statement and you're dividing it by the initial investment. So it becomes very easy to calculate. Okay. Again, it's going to include non-cash things in it. Like you'll include depreciation in it, for example. So it's not really a great measure as compared to something like NPV. But people will use it as a quick back-of-a-napkin approach because it's easy. You can pull the number right off the income statement and get a number. Now, firms will vary in how they calculate the accrual accounting rate of return. But as I said, it ignores the time value of money, and it does not track cash flows. Now, the granddaddy, the one that people are going to use is the NPV, or the net present value. And in this one here, you're taking the present value of all future cash flows expressed in today's dollars. You will use the cost of capital, which quite often is the weighted average cost of capital. And this is your minimal acceptable rate of return, or your minimum acceptable rate of return. Because if you're earning your cost of capital, at least you're covering your cost. Anything over and above that is gravy, right? You're happy with that. Now, in this course, we are going to assume that the cost of capital is the assumed discount rate, or the interest rate, and it is your minimum acceptable rate of return. And then the other measures we have to consider when looking at capital budgeting, one of them is your present value of the tax shield from CCA. Now, before November 21st, 2018, what we used to use was just the half-year rule, and the assumption here is that in your first year of owning the asset, the government would allow you to deduct, for CCA purposes, or for the capital cost allowance purposes, half of the cost of the asset. Half of the amount of the depreciation in your first year. So this is basically depreciation for tax purposes. You can't just deduct depreciation. The government tells you how much you're allowed to deduct. And if you are using the CCA tax shield, in your first year, you're allowed to take half of that deduction. Okay. Now, that changed in November of 2018, November 21st, 2018, in fact. And what they changed it to then is you are now allowed to deduct 1.5 times in your first year, and then the regular deduction every year thereafter that. So your formula, if you go back here, it looked like UCC times DT over D plus K, and that's your CCA rate times your tax rate, over your CCA rate plus your discount rate, times 1 plus a half of the discount rate over 1 plus K, which is, again, 1 plus your discount rate. That second factor is adjusting for the half-year rule, and the only change that you have to make to then accommodate the new changes is that 0.5 becomes a 1.5, and that's it. That's really the only difference between the two. I will show you a demonstration in a second video here proving out the half-year rule, and I hope that'll make it a little clearer as to why we're doing this. But what this is calculating is the present value of all of the tax savings between when you buy the asset to infinity, or perpetuity. Okay, so the idea is it's taking the present value of all of those tax savings between now and forever and expressing them in today's dollars. Okay? When you ultimately sell the asset, right, at the end of the project, you're going to get rid of the asset, so you can no longer deduct CCA at that point. You will lose the deductions, right? So you're going to calculate in today's dollars present value of all of the savings from now until forever. And then the way we calculate what happens when you get rid of the asset is you actually subtract out the tax shield lost because you've sold the asset at some point before forever. And that's worked out by taking the salvage value times dt over d plus k. Again, those letters mean the same things as they did before. Over 1 plus k to the power of n. So you're bringing that tax shield lost at some point in the future into today's dollars. And again, we'll look at an example in just a second here that I hope will clarify all of this. All right, so here's the example. You purchase equipment for $100,000. It's going to cost you $10,000 to have it delivered and installed. Based on past information, you believe that the equipment will have a salvage value of $17,000 in 6 years. The tax rate is 40%. The CCA rate is 20%. The required rate of return on this project is 10%. And the question is, what is the present value of the tax shield from CCA less the present value of the tax shield lost from the salvage value? Now again, you're going to plug this into your formulas. I'll pause, or I suggest you pause the video at this point to work out your calculations. Again, pause the video here, work out the calculations. In a couple of seconds, we will look at the solution. Okay, welcome back. We're going to look at the solution now. If you plug this into the formula, you're going to get the present value of the tax shield from CCA, which is equal to your UCC, or your undepreciated capital cost, times dt over d plus k, right? That's 20% times 40% over d plus k, which is 20% plus 10%, times, and this is the half-year rule factor, 1 plus a half times 10% over 1 plus 10%. Plug all of that in, you get to $28,000. And if you look at the present value of the tax shield lost, you get $2,558.95. Now, in case you're wondering, like, how does this all then come together? How does this work? I will show you in a separate video, and if you want to take a look at it, I'm going to use the same example here, but I will show you what this looks like in Excel. Okay, so you can tune into that video when you want to see it. Now, problems with any of this. Comparing new investments with unrealistic status quo alternatives. Like, I mean, if you don't have anything better, then it doesn't really make sense to evaluate against no other better project. Be careful about just looking at incremental or as opposed to global opportunities, right? Something might be really good for the company as a whole, as opposed to just for your department. So you want to think about, how does this impact not just your department, but the company as a whole? Make sure you consider all costs and important benefits, right? So if by taking on a project, you lose the ability to take on other projects, that's a fairly significant opportunity cost. If you're using a piece of land that you already own, make sure you consider the fact that that is going to have an opportunity cost to it. Don't just say, oh, it was free. Watch out for using excessively high discount rates. And again, on an exam, I would give you a discount rate, but in real life, you're going to have to think about what is appropriate given what it is you're investing in. And make sure you consider the type of risk, right? Projects are inherently risky. You need to build that in to your calculations. Now, how do you work out the NPV? You could do this on an entire project-by-project basis by looking at each alternative and working out all of the cash inflows and all of the cash outflows. Or you could use a differential/incremental approach. And in this approach, you're going to compare the differences between the projects and say, well, how much better are things going to be compared to where they are now? Okay. So if you're going to use the total project approach, you're going to have to look at all of the cash inflows and all of the cash outflows. I think it gives you a much clearer example of the two projects. If you're using the differential or the incremental approach, then you're going to look at how one project compares to the other. Summarizing all of this, we arrive at the 6 steps of capital budgeting. So step 1, you're going to calculate the present value of your initial cost plus any delivery or installation expenses minus any trade-in that you receive. In step 2, you calculate the present value of the after-tax incremental operating cash flows from taking on the project. Now, in a finance course, this would typically be a number that was just given to you. In a cost accounting course, this is something that will take you considerable time and effort to calculate. In fact, you're going to spend most of your time and marks in step 2. In step 3, you work out the present value of the tax shield from CCA, and this is just taking the numbers out of the question and plugging them into the formula. In step 4, you calculate the present value of the salvage, and again, if you're going to dispose of whatever that asset is at some point in the future, you get that amount, but in the future, right? You have to work out what that is in today's dollars. In step 5, you're going to work out the present value of the tax shield from the CCA lost due to getting rid of that asset before forever. Right, remember that present value in step 3 is assuming that you were to keep the asset from now until forevermore. If you're going to sell that asset, let's say in 5 years, you need to subtract all of those savings from year 5 to forever, right, from the savings you calculated in step 3. And then finally in step 6, and we didn't spend too much time talking about this, but you have to calculate the present value of any change in net working capital, right? So if you make an investment in time 0, and then you recover that investment at the end of the project, you are without that money for that entire period of time. You need to calculate the present value of your change in net working capital because that is an opportunity cost of taking on the project. So, summarized in formulas, this is what you get. And if you want to look through this, you've got your present value of your initial investment, which is your purchase cost, plus any installation minus any trade-in. Watch out for something like training costs. You can't capitalize those, right? Only look at those things that you can capitalize and actually are going to contribute to the capital, like the asset itself. Okay, so this is where you get your financial accounting kicking in here. Step 2, take the present value of your after-tax cash flows. Step 3, there's your tax shield from CCA. Step 4, there's the present value of the salvage value. Step 5, there's your tax shield lost. And then step 6, there's the present value of your net working capital. That's an outflow in today's dollars and then an inflow at some point in the future. I'll leave this on the screen for a couple of seconds because it does walk through what each of the letters mean. And again, you can pause the video here if you need to. Finally, the last couple of things that we'll talk about here. It's difficult to predict the full set of benefits and costs, right? When you're looking at a capital project, it is very, very difficult quite often to think about, well, how much is this really going to save me in year 6 or year 5? It's also difficult to project what the full time horizon of a project will be. And if you're going to get benefits or costs over a long period of time, that becomes quite challenging. It also becomes difficult where major benefits are going to happen far in the future. And let's say you were developing a new drug. You might spend a lot of money today and over the next few years, but you might not see any profit or cash inflow for 10 years. And that becomes very challenging when you're thinking about, well, how do you then model that over the next few years? In terms of evaluating managers and goal congruence issues, some firms are going to use NPV for capital budgeting decisions, but managers might be tempted to make decisions based on short-run results. So for example, let's say my bonus at the end of the year was based on return on investment, ROI. If I was to invest in, let's say, a new photocopier this year, I won't see much of the savings until well into next year. But if I'm going to make that investment, let's say, in December, well, now that's going to increase my investment. So my denominator goes up in ROI, but I don't get the return, right? So there I might be tempted to not make that investment in the photocopier, even though maybe the photocopier is cheaper now than it would be next year. A manager might still not make that investment because of the fact that it's going to bring down their ROI and consequently their bonus. We'll talk a lot more about this in the performance measurement chapter. As a last quick topic here, we're going to talk about managing the project, and this is the idea of implementation and control. Quite often we'll do what's called a post-investment audit to look at and provide management with feedback about how the project actually did. So we'll look at the actual results and compare that to the costs and benefits that we expected when we actually selected the project. And this just gives you an idea as to how well or how poorly you budgeted for the project that it is you decided to do. In the next couple of videos, we are going to look at some examples of capital budgeting and walk through what this actually looks like. I will also post yet another video looking at the capital cost allowance, or the CCA, so you can see and prove that out for yourselves as to how these calculations come together.